Have you ever wondered what is it that real estate investors do to make sure that their rental portfolio survives volatility in this current market? Well, today on this episode of the Never Lose a Deal podcast, that is what I'm talking about today. I am talking about how can a DSCR stress test protect your multifamily portfolio. So let's jump in. For the past couple of episodes, let's do a recap. I've been talking a lot about different ways for you to scale and expand your portfolio. I talked about a lot of different methods and funding strategies and financing strategies that you can use, as well as look for financing in those areas. And so today I primarily want to take the lens off of the financing for a minute and really focus on the portfolio as a whole. Because in this current market, with everything being topsy turvy, a lot of volatility, many people are wondering, is this a market to just sit it out, or is this a market to move forward? Now, me being someone who is in the mortgage industry, being a commercial loan advisor, I am still seeing seasoned, experienced investors still looking to buy properties. And I noticed that there are some who are still sitting on the sidelines. And they're sitting on the sidelines because maybe they're hoping that, we will get interest rates like we had during COVID. So without being, I'm not no Nostradamus or nobody who is a economic expert, so I do not know what the interest rates hold in the future, but I do know that there are some precautions that investors can put in place to be able to protect their portfolio. And that is called a stress test. Now, in the title of this podcast, I did say is a DSCR stress test, but it's a stress test that you can pretty much um, provide to your existing multifamily portfolio, whether you're using DSCR loans or what have you. And the reason why you want to put this stress test in place and at least measure your portfolio is because, as I mentioned to you, volatility. And so some of the things that can be volatile in a market like today can be similar to COVID. Now, during COVID, you had a lot of investors who may have had tenants who did not pay. Well, the same thing could happen with this current economy, with people losing their jobs or people getting laid off. That is the purpose of doing a stress test, because a debt stress test that you apply to your rental portfolio is a what if scenario. You can do all types of what if scenarios. So let me give you an example of what that looks like. Now, I made some notes, so I am going to read my notes because I don't want to try to keep this all in my head, but I did run some notes. And so when you're doing a debt stress test, you do want to look at some things. Now, the first thing you want to do is you want to start with baseline numbers. You want to look at your current rent roll. You want to look at the income that your property is currently bringing in. You also then want to look at all the expenses that are used in regards to that property. So if you have a property, you want to tally up all the expenses that the property is currently taking on. Now, of course, you have an accountant, CPA, bookkeeper, and they give you reports, or they have a way to email you reports, or you know how to generate your own reports, you want to start there. So you want to look at your income, then you want to look at your expenses. Now, also what you want to look at, which is the most important thing, is the debt that is on the property. Lorelia, what do you mean by the debt on the property? Meaning your mortgage payment. So many investors, primarily the ones who have the desire to be an experienced investor, but are not quite there yet. And they're wondering, well, how is it that investors in this current market can still be able to buy real estate and invest in real estate with interest rates being what they are? Now, of course, they're much lighter than what they were in a few months, but they're still not at the 2 and 3%. Well, I always tell those investors who are aspiring to become a seasoned investor is that it depends on the revenue and cash flow that the property is generating, minus what I just said, the expenses, minus the actual debt that the property is taking on. So that's why many seasoned investors, as well as experienced investors, may not be interest rate sensitive. And so, new investors or investors who have the desire to get to that point, they're not running these numbers to this extent. Almost so much to be said, many investors wait to the end of the year for their accountant to run these numbers for them. Well, an experienced investor who is looking at the volatility in the market still want to be able to have a handle of their real estate portfolio. They are looking at these numbers on a regular basis because things are happening. They are putting those what if scenarios into some type of spreadsheet to say, hey, if I'm generating revenue in this current market of $10,000, that's what my rent roll is bringing in from my multifamily portfolio. What if, once again, the what if scenarios, what if my vacancies start to get higher? Meaning people stop paying or people decide to move and I'm unable to replace that tenant at the current market rate. These are numbers and these are scenarios that investors want to put in place. So when you're running these debt stress tests, those are the things that you are doing. You are looking at that, okay, if I was to buy another property and it currently does cash flow, even with the interest rates being the way they are for a DSCR loan or any type of multifamily loan, let's take into account of what I currently hold in my holdings. Do I have the economic means to be able to still take on another property and still be able to hold and carry the debt that is currently on the property? So these are just some examples of some of the things that is done for a DSCR debt stress test. Like I said, you can do this against any type of real estate portfolio, but a lot of times, based on the information I've been sharing in the past couple of episodes, I'm primarily talking about DSCR because as you're doing the stress test, you're looking at the DSCR rate. So if you were to get a DSCR loan, I think in my last episode I talked about DSCR loans, and if you were to get a DSCR loan and that lender said, "Okay, we will give you a DSCR loan as long as the DSCR ratio is above 1.25%." Every lender is different. There's no set. So when I hear people say, "Oh no, it's got to be 1.50, it's got to be 1.75," and I always tell people every lender is different. But going back to my example, and you've gotten that loan, and the loan, it had to be at 1.5 and above, and you were able to close and get a mortgage, and you're happy with the DSCR loan you've gotten. You weren't sensitive with the interest rate because the property did cash flow, and you had a DSCR ratio that was above, 1.5. Say it was 1.65. Looked good to the lender, looked good to you, but now you still want to be able to run those same what if scenarios on to your portfolio. Because now, take into account, let's say vacancies go down, meaning things could happen. People decide to not pay, especially in states where, where I'm currently at in New Jersey and New York, they're tenant friendly states. What if, as these economic downturns continue to happen, don't mean to be a Debbie Downer, but those are things to take into consideration. New Jersey is a tenant friendly state. It is not that easy to just evict a tenant out of your property. You know that it is going to be a process. So now you have lower revenue that is coming in, the income that the property is bringing in, and your expenses went up because now you have to maybe pay your attorney higher legal fees because now you have to deal with the removal and the eviction of that tenant. So, as I mentioned to you, you're doing these stress tests to deal with the topsy turvy economic things that are going on in the market. This is how you don't invest blindly. This is what seasoned investors are doing. These are things that I work with my clients on because in this current market, now more than ever, you need to be looking at numbers. This is not a case of, this is why I tell people, when you decide to invest like an investor, go into more commercial type lending products, as I talk about a lot on this channel, DSCR being one, as well as a lot of others. It is based on the economics of the property. It is not based on house hacking. House hacking is when you buy a house that you can afford, and then now you start thinking of all the income centers that that property can bring in. Oh, I'm going to buy this property. I'm going to live in a unit. I'm going to rent out the other two. Then also in the back, I'm going to put in the back. I also have a a carport, and I'm going to rent that. To You're finding all the income centers that the property has for you to generate revenue for that property. And although that's great, and yes, you can build wealth with doing house hacking. But the thing is that, and this is what people don't understand, is that in the investor world with commercial type investing products, it's the income and the economics and the expenses of the property is determined before you get the loan. You have to do your underwriting first, as opposed with house hacking. That's not required because getting the loan is based on the economics of yourself. Can you afford the home? That's why I tell you, with the commercial lending space, DSCR, fix and flips, commercial, commercial construction, it all has to do with the actual entity. What is the economics of the entity? What are the numbers that that entity is bringing? As opposed to, you do FHA, conventional, you want a house hack, that's all based on you. You are the entity. Can you afford the property? What is your credit score? What is your debt to income ratio? Everything has to do with you. Can you afford to buy the property? And if you can afford it, that's great. Now you've bought the property, you know you can afford it, and then you start looking at all the, you know, income generating ideas that can be brought into the equation for you to generate money. But that's not it on the commercial side. The commercial side, you need to know those numbers up front because lenders only want to know, are you cash flowing? They want to know, is this property going to cash flow? If I give you a loan, is it going to cash flow? And so going back to the debt stress test, these are things that you want to take into account in this current market with all the volatility that is going on. Because unfortunately, we can't predict. We don't know what's going on in the next couple of months. We don't know another pandemic. We don't know if a war is supposed to happen. We don't know if more people will get laid off. And those are things to take into account of, especially if you have rental portfolios. What are the economics of the areas that you are in? Are there a lot of layoffs currently happening in your current area? If it is, then you have to account for that. Real life situation here in New Jersey. I mean, we're going to call a spade a spade. There's a lot of activity going on with ICE. There are investors who invest in areas where there are large populations of people who are not from this country, although they pay rent on time, great tenants, but many of them are hiding and many of them are not going to work. So what happens? Don't go to work, can't pay the rent. Now the landlord is feeling it. Whereas once, hey, I had this income generating asset, I had people who were working here, they went to work, whether they were from this country or not, but they worked, they were bringing in, they had a job, they were bringing in income, and they were paying their rent. But now people are hiding because of a lot of what's going on in the government. That takes an impact. That is an impact. These are things that investors are accounting for here in my local market. So, knowing the economics of what's going on in your area or whatever you invest in matters. And you doing these debt stress tests can help you. Like I said, I called this one a DSCR one because it's very common in the DSCR space, but it's something to look at even if you don't have DSCR loans, but you want to measure the um, you want to measure the profitability that your portfolio is currently having. And in the event that there is a downturn, do you have the means to sustain, because that's where it comes in with having other things in place just in case things can go haywire. Another real life scenario, talking to a potential client now who owns a commercial building. They've owned it a lot and they want to take out some equity. They're going to do a cash out refi because they want to have that cash cushion just in case. Plus, they went on and they've invested in some short term rentals down in Florida, and so they just want to have that cushion to have just in case. So these are things that you should be putting in place or considering if you are a real estate investor and you want to be able to ride out the volatility. A debt stress on your rental portfolio, on your real estate portfolio, if you have any debt on it. Now, of course, you may not have to do those things if you all have no debt on it. If you own everything free, free and clear, a debt stress test is not necessary. But keyword debt. So that means you are holding and carrying some type of debt on that property. So once again, this is Lorelia. If you enjoyed what I've just shared with you today, or any of the other topics that I primarily talk about here on this channel, as it pertains to real estate, creative ways of financing, my next episode, I will continue talking more about, of course, I get all these alerts. I will continue talking more about scaling and expanding your portfolio. Like I said, today was all about measuring the debt on that portfolio that you are expanding. And so I will continue to expand on this topic. If you know somebody who would be interested in these topics, please share the Never Lose a Deal podcast with that person. Leave me a comment. Let me know your thoughts. As always, want to learn more about me, you can go to my website. It is here, www.neverloseadealpodcast.com, to learn more about me and how I can assist you with getting financing for your next investment property. Until the next time, this is Lorelia.